recruiting more advisors. Maybe it's servicing the clients you've got, getting referrals, going after clients who are not being communicated with by their advisors right now. Because any advisor who thinks they were a stock picker today is embarrassed and not wanting to talk to their clients because they sold their clients how smart they were, about picking funds, and now they're paying the price for that arrogance. So those are great clients for us to pick up. So Kathy, why don't you kick us off? What changes in a bear market in the way that you adjust your business?
Well, let's start. Let's just
start.
start.
Oh, okay. I thought you were starting.
So
let's get Scott on, and I don't even see who else is on. Mark, and let's have this conversation. Let me know when you're started.
We just started it. We've got
Okay.
140 people that are rolling in here now, so things are getting rolling.
Top 140. Everybody's rolling in. So we're talking about life in a bear market, and how the reality is, should we be sitting back scared that we're moving into a bear market, or do we see it as an opportunity? And Kathy, how about you?
I see it as a great opportunity. So, Brad, there's a couple things that we do. One thing is we recontact all of our clients, okay, immediately, as things are happening in multiple times. So we've done that through this year, but we explain why a bear market is advantageous to them. So we talk about three things, and I picked this up from the managed account people, right? We talk about, number one, in an actively managed portfolio, right? An active manager in a volatile market, they're going to go buy more of the companies that they already love because they're getting them on a cheap price, right? Second thing they're going to do is they're going to go buy companies that they thought were too expensive before, but they really liked. So they're going to go in and they're going to grab those people and make sure they put them as part of their portfolio. And then the third thing they're going to do is they can make a slightly bigger bet on something. So let's say it's a sector like healthcare or something like that, where they see a whole sector kind of move down in price. Maybe they only were holding 10% of that, but now they decide, hey, there's huge opportunity here and the price is right. So maybe we'll shift our portfolio and we'll up that to 15, 16%. We can make a bigger bet because our downside risk is lower. So when you talk to people like that and explain to them, yeah, it doesn't look good on your statement, but man, there's huge opportunity and huge activity occurring because you have an actively managed portfolio. You should be there thinking, I'm kind of excited about this. So that's one thing that we do to just help them understand it better. So in the future, so we did that in March, right? And then June, we had another big downtick, and now we got another big downtick now. We don't have anywhere near the calls.
Yeah.
Because they're like, oh, they're doing that stuff Kathy was talking about, right? So I think that's a big piece of education and having them be more excited about a down market.
Yeah, absolutely. And the one thing a down market always does is it humbles the DIY guys, the people who think they can manage their own money. The people last year that were making all their money on crypto or making their money on real estate or making their money on day trading, they all thought they were geniuses and they didn't need us. And why would they pay us fees when they can just go do it themselves? Now there's a whole wave of those people who have just been humbled and realize they're not as smart as they thought they were, that maybe are interested in talking to us right now. Scott, what's your feeling about that and moving into a bear market? How do we've been around for a few of these. How do we grow through that bear market?
We've been around since the Bears were Cubs, Brad. So I agree. I'll tell you what I'm seeing is, on the end of service that you brought up, not only the DIY, but I'm amazed at the lack of service that people get at these big wirehouses, right? The Merrills, the Morgan Stanleys, the JP Morgan Chase, right? Like if our people on this call need to understand that if somebody doesn't have $1 million there, the odds are they are getting terrible service. And people aren't. I was on a Zoom the other day with with somebody and they were on with their Merrill person, and you could just tell this person had 450,000 at Merrill, and you could just tell that this Merrill person is the first time they've looked at it because they were figuring it out with us what was going on. It's not like they got on knowing what was going on. You know what I mean? So I just, the service end of this, like these kind of markets is really what's going to bring out the bad service. Like people knew they were getting bad service, but their expectations were low. Their return was good in the portfolio, so they looked past it. These markets are where it comes to a head, and we just got to make sure we're taking advantage of that, you know?
Yeah, 100%. Listen, all great realtors love downturns in the market because it washes out the people that are not serious about being in the business, that don't do things right. And in our business, that's what happens. It washes out a lot of weak advisors out of other companies who don't do what we do, and then leaves a huge amount of clients without service that we can go pick up on. Hey, Mark, what about you? We've been through a few of these. How do we grow through it?
Well, I think, we're always looking for opportunities. When we discover opportunities where people have assets, we're sitting down with new families. A lot of it is what Kathy and Scott spoke to, is this service thing, is that they're not getting that service, not just from the wirehouses, they're not getting service from anybody. And so when the market takes a downturn like this, people are wondering, how is my account doing? Right? They see these negative, they see these returns that are negative, they've lost money, they're not in regular communication with an advisor. So that is an opportunity for us to grab those assets simply because you can have a conversation. Why? Because they're open to a conversation about their negative statement, right? It's not to say that it wouldn't be negative with us, but they're just not having that communication. We reach out to our clients every quarter. Every quarter, our clients get a phone call from us. And so we, as Kathy mentioned, we don't get a lot of calls because we're calling already. We're already proactive. They know we've got it. We have conversations with them like, if you're saving money for retirement, this is a buying opportunity. Everything's on sale. I don't know why it is, but with investments, it's the one area that people seem to run from sales. You were willing to spend $50 a share last week. It's out 40. Now's the time to buy. We don't walk into Kohl's and say, oh, you're having a sale, I'll come back when it's full price. This is an opportunity. And these are the kind of conversations that I have with people that are putting money in. Just keep putting money in. If you've got extra money, put more money in, right? And if you're retired, those are the ones that have the most concern. But I let my retirees know, I say, look, our planning prepared for these downturns. And we expect them. When we talk to you about averages, we can't just take the 20% years, right? We've got to take some of those downs, but over a long period of time, it's going to perform. So it's important that we have these little conversations with people, but I think it's a tremendous opportunity.
Really great tips. Downturns are priced into what we talk to you about, and we're not trying to hit home runs. You win the game on singles, really, not on home runs. And so that's the way we play. So great tips and great ideas. One last thing, it's always harvest season for the investment business for us, because in a bear market, we're in business and gathering more assets. In a bull market, we're gathering more assets. But right now, it's really harvest season for recruiting advisors. People who are so worried about inflation, they're being so hammered on their mortgage rates as they're, especially in Canada, when they're renewing. We saw another 3/4 point interest increase yesterday. That adds $42 a month per 100,000 on a person's mortgage. And so a lot of people are seeing $300, $400, $500 a month increase in their variable interest rates up here. And so this is a great opportunity for us to go and grow our advisors during this bear market as well. So anyway, thanks guys. What an awesome panel. Kurt, we're going to turn it over to you, buddy.
Well, man, hey, we're excited about today. And man, y'all should have been tuned in early, because I was learning some stuff in the early part. There was some great ideas happening here. Well, listen, today we're going to spend time in a bunch of different topics and a bunch of different areas. So we're going to see if I can figure out the technology to make this happen. That's always a scary thing when I try to figure out technology. Hey, you're making me feel better. Thanks for saying that.
It's
So
looking good.
let's dig in here and walk some through some things. Okay, so if you've seen us speak this year, the next slide you're going to roll your eyes on. Okay, but these are what your clients look like right now. They're watching the news. They're scared. They're panicking. They're nervous. They're wondering. These people need you desperately. Okay. And what they need from you is for you to be calm, you to be consistent with the advice you're giving them and not fluctuate. Okay. So I'm going to share with you a couple things on what I see, okay, is happening in the economy right now. And usually what my thoughts, and $2 get you a cup of coffee at McDonald's. So we'll see how we're doing here, okay? So this is an article from August 12th, and I found it really interesting, the statistics in here, because they're saying as of August 12th, the S&P 500 had made up over half of the downturn that had taken place in this. Now, if you look at the bottom, okay, you'll see since 1950, there's never been a time where the market has went on to make a new low after it's made half of the market back. That gives me a degree of confidence we've already found the bottom, okay? This is an article from last week, okay? Wharton professor Jeremy Siegel, right? Inflation is improving. The Fed, their aggressive rate is against what the economy appears to be telling us. The second bullet point, 26 of the 27 inflation indicators were below expectation. His thoughts are the Fed shouldn't be as aggressive as they're going to be. Here's an article from early morning, September 6th, right? Treasury yields rise, strong economic data, better than expected data came out, right? The supply management on manufacturing PMI was better than expected. Again, they're saying, we don't know that we don't think the US is gonna have some heavy recession, okay? We think they maybe can even avoid it, quote unquote, all right? Another article from the same day, economy is looking like it's strengthening, okay? Goldman Sachs sees encouraging signs. Fed rate hikes, right? Don't need to be as aggressive as they're gonna be. And they think inflation will come down without a gigantic hit to the economy. Current roles, current things happening, okay? Now, excuse me, I'm sorry. I wanna talk to you about the critical role that you play in your client's future. And I'm gonna give you a different spin on a page out of the presentation than you've maybe taken, right? All of us have seen this presentation, right? Your FIN number, 30,000 is 73,000, you know, you need to have $1.8 million, you know? So I don't know if you ever read the fine print on that or not, but that assumes that you're getting a 9% return while the money is growing and a 6% rate of return in retirement, okay? $500 a month. Most clients could look at that and not break into laughter. Oh my gosh, you know, but look at this. What about if you're only getting a 6% rate of return while your money's growing and a 4% rate of return on retirement? Now it's $1,300 a month to hit your $1.3 million FIN number. And what if you're a bank, you know, a person's a banker, right? They want to be in the bank, getting a 3% rate of return while it's growing and a 3% rate of return on retirement. You need 1.45 million. You got to save $2,500 a month. It is critical that we all get better at our investment business at educating clients and growing the volume of representatives we have. Because what client do you and I meet that's got $2,500 a month? Okay, that's like a joke. Some people make $2,500 a month, okay? So you are critical. Here's another reason why you're critical to your clients. These people came in and saw me last week. They brought a couple of statements in, okay? Here's a 30-year-old in a 403B plan, okay? They said, we want you to tell us How are we doing? We did their FIN number and that kind of stuff. I want you to look at the 403B. It's all in a fixed interest account getting 1.8%. A 30-year-old person, okay? We can't do the FIN number on that because you'd have to make Arlie Larson money to be able to afford to invest that much, okay, to hit that goal. So it is critical that you and I see more people, because people don't have any idea what's happening. They have no idea what's going on. Here's another one that we're hearing about now, right? Gold, gold, gold. You've been hearing that all year long. Invest in gold, invest in gold. Well, here's an interesting statistic. Here's a 220-year study of gold versus stocks and bonds and treasury bills. Notice stocks over that 220 years, right, turned $1 into 2.3 million, right? Bonds into $2,163. Gold into $4.06. Gee, should I have all the money in gold? Only if you don't want to retire, probably. Okay. So, what I see, we only run across that when the market is having trouble, which is the exact time when you want to buy into the market, not take your money out of the market. Okay. So I just found that's an interesting thing. Hey, I'm going to share with you the investment philosophy that we have developed in our thought process and why. Now, as I jump into this, I may talk about some things that don't agree with how you do stuff. Take the best and leave the rest, okay? Disclaimer, take the best and leave the rest, all right? But I think you need to have an investment philosophy that you personally believe in, and you don't change every time the wind blows, right? I mean, it's like, hey, this is what I believe in. Until something super hard evidence changes my mind, I'm not changing my mind, okay? So the first thing we think is this: all clients are important regardless of the size of their portfolios. The vast majority of the people that you and I meet aren't rich when we meet them, but they're going to come into money someday through their 401k rollover or the $68 trillion wealth transfer, or 87 now, whatever it is, right? So they need to be important regardless. I was a guy that started with $25 a month, okay? Because that's what I could afford when I became a client, back when Columbus sailed, okay? So it is important that everybody realizes you are an important person. I spend an hour with people that invest $50 a month. From an economic standpoint, you would go, that's crazy. We need to never forget where any one of us came from, okay? All of us were broke at some point, and we need to realize I needed help and our clients need help. Second of all, we believe asset allocation and diversification are critical. And I'm going to show you some charts on that today. Third of all, we believe that if we minimize the downside, the upside doesn't have to be as exciting for the client to still make good money. All right. An example that I will use when I'm talking to clients there is this, right? Do you remember when when your kids were in school or you were in school and you were getting all A's? I don't remember that, but if you were getting all A's and you got an F on a final, right? What did that do to your grade point? And the answer is always, oh, that was really bad, right? Exactly. But if you're getting all B's and get a C, that is painful? And they always answer no. That's why I want to run your money. I want to get B's and C's. I want to make money in the good years and not give it all back in the bad years. Does that make sense to you, Mr. and Mrs. Client? People love that, right? Next, okay. Next, we believe in the taking time to help our clients understand their options. I take as much time as maybe anybody. I'm slow, methodical when I'm working with people. But, I believe people are fed up with fast talking, high pressure, hard closing salespeople. I don't want to be that person. I want to develop a relationship, not a sale, because a relationship will last for a lifetime. Okay. We believe customer service is vital to helping our clients reach their goals and dreams. And we were hearing about that. Kathy and some other people are talking about that earlier. Should have been on earlier. Okay. That's when the good stuff happened. Customer service, helping people understand and achieve, right? people won't leave somebody that they believe truly has their best interests in heart and treats them like they're important, okay? We believe dollar cost averaging is critical. Like virtually none of our clients go, hey, here's my 4 million, let's jump in the market and see what happens. No, they go, hey, I got $200 or $300 a month, and we're going to help them get started. So we love teaching dollar cost averaging, okay? We believe that investing in companies domiciled in the US is the only way to go. I'm going to give you some charts in a few minutes. These charts are my opinion. You can disagree, all good, right? Again, this is that personal investment philosophy, okay? We believe that we need to be consistently increasing our knowledge, increasing our skills to help our clients reach their goals and dreams. None of us got it all figured out. We're all figuring it out, just at different levels of figuring it out, okay? So let me share with you a couple things here, right? I want to talk about asset allocation, diversification, and I'm an anti-international investor, okay? Again, this is my opinion. If you like international investing, go for it, okay? I do this study every year. The reason you want to attend everything, years ago, I was speaking for Lake Mason in Wisconsin, Minnesota, some different meetings they had. And I watched a guy from the home office of Lake Mason say something, and it was like the light switch turned on, and I started developing this chart and studying this, okay? So I'm using indexes, the S&P 500, S&P 400, Russell 2000, the MSCI AAFE for international, and the Barclays Aggregate Bond, okay? Let's go back to the decade of the 1980s. The S&P averaged 18.754% for a 10-year time period. At that point in time, Morningstar doesn't show the mid-cap index, the bond index, or the MSCI. Let's go to the decade of the 90s. In the decade of the 90s, the S&P average is 18.2. For 10 years, that's crazy. So if you look at that 20-year stretch of time, the S&P average is 17.87% per year. Your money virtually doubled every 4 years. It was like, again, they were talking earlier, right? You had like the do-it-yourself experts going, I don't need you. It's all good, okay? Surprise, surprise. At Y2K, there was a significant change in the market. The S&P has averaged 7.53 since Y2K. And mid-cap is where the profit has been since Y2K, followed by small cap. I want you to notice where international falls, okay? No, don't go visit international falls. Notice where international falls, okay? If we look at the last 30 years, mid-cap followed by large and small, again, we'll see where international falls. If we look at the last 25 years, we're going to see the same results. If we look at the last 20 years, okay, we're going to see the same results. If we look at the last 15 years, large cap has now done better. You're going to see mid and small. You're going to see where international falls. If we look at the last 10 years, you're going to see where international falls. If we look at the last 5 years, if we look at the last 3 years, if we look at the last 1 year, okay? So when I'm meeting with people, right? When I'm meeting with people, and I'm going to tell them, part of my philosophy is I'm going to invest in companies that are US companies. Here's the terminology I use. Hey, I don't want any my Canadian friends calling them beat me up now when I say this, okay? So, because I'm pretty sure you all play hockey up there, you could all beat me up, okay? So don't want that happening, okay? So when I say to them, right, you know, Mr. and Mrs. Client, right, I believe investing in US companies, right? Because if we look at the last 1, 3, 5, 10, 15, 20, 25, and 30 years, the 3 basic US indexes, the large cap, mid cap, and small cap index, have all beaten the international index in every single time frame. Therefore, I don't understand why I would take additional risk to invest internationally, additional risk being currency exchange and less stable governments, to earn a lower rate of return on my money. I would rather place my bet on the good old USA, not China and Venezuela. Wouldn't you agree, Mr. and Mrs. Client? And every client goes, yeah, you know, they love that terminology. Okay. We've heard many times on MPI, stories are how you teach. Okay. Let's talk about asset allocation, multiple sectors of the economy. Okay. So let's look right after Y2K. How long did it take for you to get back to even? All right. If you were in large cap stocks only, it took over 6.5 years just to get your money back to where you were. If you had a mix of small, mid, and large cap stocks, it took about 3.75 years just to get back to even. Okay. It's much easier to keep a person with you for 3.75 years than 6.5 years when they're losing money. Okay. Let's look at a newer study. How about 2007 when that downturn took place, right? If you had large cap stocks only, it took nearly 5 years just to get back to even. If you had a mix of small, mid, and large, it took less than 3.5 years. Again, same concept. We have to keep the clients comfortable going, you're buying, it's all good, you're going to make it, but it's easier to keep them comfortable 1.5 years for 1.5 years less than it is if they're only in large cap stocks. Okay. So let's talk about that same concept in a different analogy, right? We saw at the end of 2008, it was the first time the S&P 500 had ever had a 10-year loss in the history of the market, followed by 2009, the second time. Okay. So let's see what happened. What if you had an allocated portfolio instead? Okay. So at the end of 2008, if you had large cap stocks only, right, you had 100,000 turned into 87,000 over that 10 years. If you had large, mid, and small in your portfolio, that 100,000 turned into $125,000 over the same exact time frame. The client had 30% more money with a diversified portfolio versus just a large cap portfolio. Okay. How about second lost decade in a row, 2009, right? Never happened before. All right. At the end of the second time frame, right? 100,000, right, turned into 90,000, but in small, mid, and large cap, 100,000 turned into 135,000. So the client had 32% more money, almost 33, if they had a diversified portfolio. So one of the things we look at, I'm going to show you some things in a few minutes. We're going to go in a few different directions today, but we pay attention to asset allocation, diversification, and non-international. This is the evidence that we use. Okay. Now, I know right now nobody could go, hey, the market's too high, but you do have people saying, should I wait for a better time? Okay. I'm going to give you an analogy. Let's see. Scott, are you a hunter? A deer hunter?
No.
Eldon, who's a deer hunter? Eldon, are you a deer hunter? Anybody? Kathy Brennan's a deer hunter. Kathy Brennan. Okay, so Kathy.
Yeah, I'm really good. Really good.
I don't doubt it. I don't doubt it. Okay. So for you, the users that are not deer hunters, okay, I'm a deer hunter. Tons of my clients are deer hunters. I'm going to give you a story to teach us, and I'm going to give you some answers, some other stuff, right? So a 180 buck is called a Boone and Crockett buck. That's like the holy grail. You shoot one of those, it's like you are it. Okay. So if Kathy and Matt are sitting at my desk, right, and they're going, well, you know, I don't know, is the time right? Should I wait? So Kathy, go ahead and turn your mic on, ma'am. Right. So were you playing me? Are you really not a hunter, or are you a hunter?
I was lying.
Okay, well, you now are a hunter. Okay. So a 180 buck is the holy grail. That's like the dream. Most people will never see one in their lifetime, ever, let alone shoot one. Most people will never even see one. A 170 is a monster. Okay. So Kathy's making believe she's Elmer Fudd, Miss Hunter. Okay. Now, so Kathy, so she's going, do you think it's the right time, or should I wait a little bit? Say, well, Kathy, let's analyze this, right? Let's say this year, right, you think there's a 180 on your land that you're hunting. You haven't seen it, but you think there is. An opening day, a 170 presents itself at 15 yards broadside looking away, a perfect 6x6. Are you telling me you're going to pass the 170, the biggest buck of your lifetime, in hopes you might see one that you think might be there? Or are you going to take that 170, Kathy?
I'm shooting. I'm shooting.
Okay, that's the answer everybody says. Exactly. So Kathy, the market could go lower. We could hit a booner, but there's a 170 right now presenting itself. What do you think you should do with your investment at this point?
I'm buying.
Exactly. So that's a story for deer hunters that they go, got it, I'm in, okay? But thank you, Kathy. You're a great hunter. Let's look a little deeper, okay? So again, it's not the market's not high, but it's a concept to teach, right? If they go, should I wait? Well, look at these examples. Let's look at 1987. The market peak was August 25th, was an all-time high before we had the worst single day in the history of the stock market, okay? If you invested at the worst possible time, right, the appreciation fund returned 9.5% since then, right? 231,000 bucks off your 10,000 original investment. CDs have did about 3 cents in, you got 27,000. Worst possible time, look how you did. Let's go to the 2000 downturn, right? The market high in 2000 was March 24th, right? Before we had the market high before the worst decade in the history of the stock market. The appreciation fund returned 7%. CDs did about 2 cents then. So your 10,000 turned to 41,000 appreciation fund, 15,000 in the bank. Let's look at a more recent one, 2007, right? The market high was 10/9 of 2007 before the greatest downturn since the Great Depression, okay? The appreciation fund returned 9%, CDs did about 1% since then. So your 10,000 go to 35,000 or 11,000 at the bank. And how about the most recent one, 2020, okay? The high was 2/19 of 2020 before the fastest decline in the history of the market, okay? And the appreciation fund returned 14.5 since then, and cash has did about 1% since then. So your 10,000 was almost 13 in appreciation. Your 10,000 was 10,000 in the bank. I don't know, Mr. and Mrs. Klein. You think the market's too high right now? No, we should get going, okay? So these are 4 of the craziest times in any of our Primerica lifetimes. Market still won gigantically, okay? So no, it's not too high. Shoot the buck, Kathy, okay? Now, let's talk about overcoming objections, right, for a couple of minutes, okay? So overcoming objections, right? When we are communicating with people, 55% of the message they get from you is body language, 38% is tone of voice, only 7 is content. So the reason we should memorize the closes verbatim is this. Total focus should be on body language and tone of voice when you're communicating with the client, not, well, then we said, okay, you want to know it verbatim, so total focus, you're talking to the person. I probably never say any close verbatim anymore, okay? Because in theory, I've learned a lot. So I might miss word around here and there. It doesn't make any difference. It's how is the client reading you? So how about this one, right? They say your sales charge is too high. Eldon, you got your mic on? So Eldon goes, hey, your sales charge is too high. I go, hey, Eldon, that's fantastic. Can I ask you a question, Eldon? Do you guys ever go out to eat?
Yeah, you bet.
Okay, fantastic. Because you have a good meal and good service. Do you leave the waiter or waitress a tip?
Yep.
How much normally?
15 to 20%.
Oh, so what I hear you saying is you think it's more important for a waiter or waitress to pay, bring you a meal and fill your water glass than it is to pay me a lower percentage to help become financially independent. Eldon, does that really make any sense to you?
Nope.
Great, let's get started, okay? And it's like over with. Even though I messed it up, right? The content's there, right? So it's hard to argue. He's got to be a total hypocrite now if he goes, well, yeah, but there's no, well, yeah, but they go get the checkbook. Let's go. Okay. How about this one, right? Low fee index funds. Okay. We run across those, not a lot in this kind of stuff, right? But Eldon goes, hey, I heard a low fee index fund is better. So, hey, listen, that's fine. Eldon, may I ask you a question?
Yep, go ahead.
Okay, fantastic. Do you realize when you choose index funds, you're guaranteed to never beat the market?
Well, I didn't know that.
Yeah. Well, see, even though with index fund, if the fees are really low, the fees do take away from the actual index return. Therefore, you can never beat the market. Eldon, would you rather have an active and managed fund and have a chance to beat the market, or have an index fund and be guaranteed to never meet the market?
Well, I do like to beat the market.
Great, let's get started, okay? And again, I messed that up, but the concept is there, okay?
Yeah.
So thank you. So overcoming, so I've got the fee guy and the hunter here, okay? In this, we're doing great, okay? Fantastic. So don't be concerned about fees. Fees aren't an issue in the absence of value, okay? Fees are not a problem. You provide a service. Look at the 403B person I showed you 3 minutes ago, okay? You provide a service, okay? So let's spend a minute talking. I'm going to talk about retail mutual funds for the second. I'm going to give you an actual example that we recently ran across. Happens to be the husband of the woman that was a 403B earlier, okay? Happens to be same couple, okay? So I'm going to talk a minute about Morningstar and give you some thoughts on how we do that, okay? So I love portfolio solutions. In portfolio solutions, these are the options available. I encourage people always use the S&P 500 in portfolio solutions. Here's why. If you let it default, the plan on the left, we're going to show you is what the client currently earns. And the plan on the right is what you're recommending. Morningstar is going to try to build a benchmark to match each of those. So the benchmark is not the same. I don't like that. I want to compare both portfolios to the same benchmark. Now we can talk to the client and show them, how we're doing compared to the other one exactly, not how we're doing compared to the blended benchmark design. So we also use S&P 500. The portfolio comparison report, 99% of the time is all you need, okay? All you need 99% of the time, all right? Now, I'm going to show you the things that we teach our reps and we talked with our clients, right? We look at beta. Beta is now I know this is general to a lot of you, all right, but maybe not to all of us. Beta is a measure of risk, right? We're using the S&P 500 as the index. So if you have a beta higher than 1, your investment's more aggressive than the S&P 500 or more volatile. If it's less than 1, it's less volatile, okay? We also pay attention to something called alpha. Alpha, if you look at the last sentence, right, it's seen as a measure of value added or subtracted by the portfolio manager. So if you're putting the portfolio together, I'm going to show you in a second, right, and you have better alpha than what they currently have, you've got a better portfolio put together than they currently have. We talk about Sharpe ratio, okay? Not Mike Sharpe ratio. Well, that would be really good. Just Sharpe ratio, okay? And if you look at the last sentence, right, reward per unit of risk. We would like a high Sharpe ratio. We're getting more reward for the risk that we're taking. So here's what just happened, right? That same couple came in. He's got a 401k with JP Morgan, not to mention names, okay? JP Morgan. He's 35 years old. He wants to be aggressive, okay? He's putting in 3% more than the match, okay? And he's got an advisory account inside. So I put together, I just do it right in front of him because if his plan's better, keep it. If our plan's better, think about changing, okay? So when we look at their portfolio, the first thing you're going to see up here, right, is they've got 28% in international. That's a red flag in my eyes. And they got a little bit of money in bonds. That's a red flag in my eyes if you're a young guy trying to be aggressive. If we look at the portfolio, actually not a bad looking portfolio. I don't have any really challenge with that. This is the one that I recommended to them. I'm just a little heavier than I want to be in large growth, but that's because I'm going to talk about the funds in a minute. I've explained this 100 times on our portfolio designs. Okay, but I'll do it again 101 times, okay? So let's look. This is the order we go through with the client. We're gonna look at the beta. Okay, their 3-year beta is 0.95. I'm sorry, I'm looking at a different screen right now so I can see it better. Their 3-year beta is 0.95, 5% less volatile than the S&P 500. Our 3 years 105. We're 5% more volatile than they are. Their 5-year is 0.95, we're 104, and their 10 years 0.95, and we're 103. Our portfolio is about, on average, about 9% more aggressive than what theirs is. Okay, 35, they want to be aggressive. I don't got a problem with that. Okay, second, I'm sorry, back up. Wrong way, Kurt, you can do it. Did I mention technology? Okay. Second thing, look at their alpha. Their alpha is negative 3.56 for the 3 years. Ours is negative 2.26. I don't like negative, but I like -2 better than -3. Okay. Their 5-year is negative 379. We're positive 114. And their 10-year is negative 25, and we're positive 0.83. We have a better designed portfolio. Our portfolio, the manager's adding more value than their current manager has. Okay. We look at Sharpe ratio, reward per unit of risk. Their 10-year is 0.47. Our 10-year is 0.55. Or I'm sorry, 10-year, 3-year. Their 5-year is 0.43. Our 5-year is 0.73. And their 10-year is 0.72. And our 10-year is 0.95. Even though our portfolio is more aggressive than theirs, we're offering significantly more return, AKA better Sharpe ratio. Now let's look at actual returns. Their 1 year is negative 16. Our 1 year is negative 25. Okay, is that bad or good? I'd rather, well, I'll let you decide. I'm going to give you my viewpoint. If I'm buying, I like my negative 25 if it's a good long-term portfolio. Okay, I don't, year to date in 1 year, if ours is a zillion and theirs is -3, that doesn't mean ours, it's 1 year. I look for consistently 3, 5, and 10 long-term, what makes more sense. Their 3 year is 7.75 a year. Our 3 year is 10 a year. Their 5 year is 7.1 a year. Our 5 years 13.2 a year. Their 10 year is 9.6 a year. Our 10 year is 14.2 a year. Not difficult to get them to change. Okay, what's it look like? I use 3 funds. I use this ClearBridge Select, ClearBridge Dividend Strategy, and Franklin Dynatech. The reason we're heavy in large cap growth is Select and Dynatech together are multi-cap growth, and they're a little heavy there when you use them in conjunction, but they're both good funds. So that's how we use that. Now, this guy was putting in 3% more. Obviously, our funds kill what he's doing. He's putting in 3% more, okay? So should he invest in this non-matching pre-tax at work, or should he stop above the match and do a Roth with us, right? We teach people match is the first place you invest for retirement, even though it's not with us, because I try to be a good guy, but I don't give free money, okay? They should take free cash. After that, almost always the Roth is going to be better. These are 3 charts I've just memorized, and I use them all the time with people, right? $100 a month at 12% for 40 years, 48,000 of principal, $1.2 million of growth. $1.2 million is the value. The non-matching fund at work, you're going to get a tax break on the 48,000 and pay taxes on the $1.2 million. The Roth, you're going to pay taxes on 48,000, get a tax break on the $1.2 million. Which one do you like better, Mr. and Mrs. Client? Pretty simple. 30-year number, 20-year number. I just memorize those when I'm meeting with people. I don't have to draw it out. I just talk, I'll draw it out and show it to them, but I don't have to do calculations. So how do you verify they should do the non-matching money with you in a Roth? Okay. This guy's 35 years old, retirement goal is 65. I did the FIN number. So here's how I did it, right? That same $100 a month at 12% for 30 years, the principal's 36,000, the value's 352. If the tax person says that darn Primerica person, I'm sorry, tax person would have said, that darn Prime America person, okay? If they just said that, all right, here's how you will go over that with them. The tax person's job is to save you money this year. I'm talking about your retirement plan. I'm looking at your lifetime, not this year. So let's look, okay? If you're in a 22% tax bracket today and you're only going to be in a 12 in retirement, is a Roth still better? Let's analyze. The 36,000 of principal, if you put that in and get the 22% tax deduction, you're going to save almost 8 grand over your lifetime. You got 352 at retirement, even though you're in a lower tax bracket, 12%, you're going to pay 42,000 in taxes later. Would you rather pay 8,000 or 42,000, Mr. and Mrs. Client? Okay, simple choice. Now, we're not going to go deeper in that because we're going to run out of time today. Let's talk about managed accounts for a few minutes, okay? Again, these are my philosophies, some of these. The first one's our pricing structure. I'm going to share with you why did we choose this pricing structure, okay? So this is how our hierarchy prices managed accounts. We start at 1, 2, and then we're going down by 0.1% all the way down the chart. The home office currently defaults at 1 all the way across here. The reason we change that is in red on the bottom. Most of our clients don't have $1 million to start with, but many of our clients have 250 between husband and wife, okay? Everybody likes a deal. Everybody likes value, okay? So if I'm talking to Kathy and she's got 170 with me and Matt's got 100 grand somewhere else, when I show them, if that money was here, Kathy would get a volume discount on her account and so would you. You know what they do? They bring the money over because they're both getting a deal. Everybody wants a discount. Everybody wants value. So that's how we price, okay? Start at 1, 2, and go all the way down. Next year, when the new platform, when the adjustments come out, you're going to be able to save your own pricing structure for you, but that's not today, okay? So let's talk about managed accounts a little bit, okay? And talk about some value that they provide to people, okay? I was a guy, Sarah, I don't know, last fall or something, we did an MPI and I talked about why I was negative and how I changed my mind. But I was that guy. I ain't doing them. I ain't doing them. I ain't doing them. I guess I'm doing them, okay? So let's talk about it, okay? Most people, let's talk about recovery, okay? Most people think if you go down 20, you got to come up 20 to get back to even. That's not real, okay? If you go down 20, you got to come up 25 to get back to even. So again, a picture, a story, right? Okay, Scott, managed accounts, you know, the stock market goes like this. Managed accounts are going to cut the peaks and the valleys off. Your money's going to kind of wiggle like this instead of wildly wiggling like that. So for example, right, in 2020, right, the market goes down almost 40% in a month. Do you realize you got to come back 67% just to get back to even? Did you realize you had to go up that much, Scott, just to get back to even?
Did not.
Yeah, I didn't either, right? I thought down 40, up 40. So with the managed account, right, what if we could only go down 25 during that time frame versus 40? It's a lot easier to get a 33% positive year than it is to get a 67% positive year. Does that make sense to you, Scott?
Does.
So if we can minimize the downside a little bit, we can still get a good return on our money. Okay, then this chart is awesome. Okay, and I'm gonna talk to Scott again. Okay, 2 different investors, right? So here's another example, Scott, 2 different investors. Portfolio 1, kind of an exciting, volatile, really good years, not such good years. Portfolio 2, a little more mundane, maybe a little bit more boring. Let's analyze them, right? In year 1, the exciting one went up by 30%. The more mundane one only went up by 25. Year 2, exciting one went up by 20. The more mundane one, only 16. Now, the exciting one went down by 5 in year 3. The more mundane one, only -3. Year 4, the exciting one went down 8. The other one only went down 5. Year 5, the exciting one went down 15. The other one, mundane one, only about 9. And then the exciting one had a great year, went up by 20, and the more mundane one only went up by 18. The exciting one averaged exactly 7%, and he had $139,000. The little bit more mundane one averaged the same 7%, but had $143,000. Which portfolio do you think like better, the exciting one with 139 or the more mundane one with 143?
More mundane.
Yeah, so that's the objective of a managed account. If we can cut the peaks and the valleys off, we can still get a good return and hopefully have an extra dollar in your pocket. Does that make sense to you?
It does.
Okay, so just teaching the concept, because I struggled with, hey, the retail one did 40 zillion this year. This one, I only did 30 zillion in the managed account. What happened? Over time, it's proved, oh, they're a great strategy, okay? Let's talk about portfolio rebalancing for a couple of minutes, okay? This is a very, very important thing that in retail, our clients typically don't get, okay? So if I was talking to Brent, okay, Susan would have had my folder sitting in here already prepared for me. I opened up Brent's folder and I highlighted the couple funds that, that we might adjust or look at. Maybe I had 4 funds in Brent's portfolio, 25% in each. Well, when he comes to meet me next year, guess what? They all didn't grow at the same rate. So one's got 30, one's got 20 in it, right? So portfolio rebalancing, here's what happens. If you want a client to be a 60-40 mix, we know over time stocks, Brent, grow faster. I'm Brent Lanty, so I'm talking to, okay? So stocks grow faster than bonds long-term. Sometimes they can nip and ganop, but long-term, that's what happens. So if history keeps repeating itself, the 60 portfolio 30 is going to become a 70-30 portfolio. You have more money in stocks than bonds. Did your volatility just go up, Brent, when you have more than stocks than bonds?
Brent is stumped.
Sorry, I was on mute. No.
So did your volatility go up, Brent, when more money got in stocks and less in bonds?
No.
Yes, it did. It went up because you have more in
Oh,
stocks
sorry.
than bonds.
I misunderstood.
So normally, say I'm not that good a teacher. So normally, okay, do you want your portfolio to get more aggressive as you get older, Brent?
Less aggressive.
Less aggressive. So what happens with rebalancing, when the stocks get too high, they sell some and put them back in bonds. They sell high and buy low to bring your balance back. When it goes the other way and the bonds are doing better, they sell high and buy low to bring your balance back. You like the concept of selling high and buying low, don't you, Brent?
I do.
Yeah. So they're going to automatically do that for you in your portfolios. Now, it's a habit. I'm watching myself. The habit is I shake my head yes. Okay. Now, here's what's interesting. You guys were shaking your head yes when I was doing that, and I wasn't talking to you because that's a natural thing that people do. Okay. So with a lifetime portfolio, there's 3 different rebalancing ways they do this, right? Number 1 is the basic rebalancing. Every time money comes in, every day or whenever it comes in, I'm going to oversimplify this, but I want to teach the concept. If there's 4 funds in the portfolio, and there's 25% in each. If one of them has fallen to only 24%, every time money goes in, they're going to infuse that into the undervalued sector before they go anywhere else to bring that balance back up again. In essence, your clients are buying low every time money goes in. That's good. Okay. When money is coming out, maybe in that same portfolio, it's supposed to be 25% in each, and one of them has fallen to 24, and maybe one has grown to 26% instead of 25 4 ways. Again, none of them are that way. I'm just trying to teach you a concept. So when the client takes money out, they're going to sell the upper value, the 26% sector first, to bring it down before they sell anywhere else. So every time your client puts money in, they buy the undervalued sector. Every time they take money out, they sell the upper valued sector. Genius, okay? So when people take systematic withdrawals, it doesn't come from the same place every month, which is totally cool. Okay. Second is inside each individual model. Okay. If any sector gets 10% away from objective, we build, so next we'll talk about this. So maybe there's supposed to be 15% in one sector. 10% of that is 1.5%. That means if any sector gets 1.5 above, or if that 15% piece gets 1.5 above or 1.5 below, triggers a rebalance. They look at it daily and rebalance weekly as needed. Okay. And then the third way is called model drift. All right. So we have an example of, I build UMAs. So if we have a 60-40 UMA, a moderate growth client, I'm going to have 2 equity managers and 1 fixed income manager. Okay. So here's what happens. If the 60-40, if that gets 5% away, the equities go up to 65 or they go down to 55. Either way, that triggers a rebalance. They're going to sell the high ones, buy the low ones, and bring it back. Now, inside of that, if I've got 60% equity and there's 2 managers, there's 30% in each equity manager. If either one of those two get 5% away, one side gets up to 35, one side goes on to 25, that triggers a rebalance and they rebalance a portfolio also. Okay. This rarely happens because of the first 2 ways. Okay. They check it twice a year, but Matt Patrick, who does all, he said it doesn't happen virtually because of what we've got built. Okay. Now let's wrap up. The hardest prison all of us have to escape is the one between our ears. Okay. Us thinking that was too complicated. I can't do that. I'll never be as smart as, Brad Gerard, all that kind of stuff. Okay. That may be true, by the way. None of us may never be as smart as Brad, but other than that, okay, here's the thing. If this stuff was like, oh, that was a little, I've been doing this, Christopher Columbus was my first client. Okay. So I've been doing this for a long time. And every day that I'm in my office, I'm working in this stuff. So it's old hat to me. Just like your old job, when you got good at it, was old hat to you. Same thing. So if some of this stuff is new today or different, or I don't know, or whatever, don't worry about it. Okay. Repetition is the mother of learning. You keep doing it and learning a little bit more, and you keep doing it and learn a little bit more. And what happens is you're going to go, well, Kurt did that kind of crazy. I like this way better. Do that then. Develop your own philosophy and do that. It is all good with that. With that, I'm going to turn it back over to whoever's got questions and answers today.
Oh, my Lord. Kurt, that was, what a clinic. Can you hear me okay?
Yes, sir.
Yeah. Dude, that was fabulous. Really, that was tremendous. We got 3 marriage proposals for you. Mark Drake would like to have his proposal answered first. just so file that one later. Kathy Brennan had a couple of hunting things she wanted to clarify. Kathy, you want to jump in?
I did. I just got finished, like I said, Scott, cleaning my rifle, so I'm all set. Okay, so team, right? I just wanted to clarify something I said in the beginning in the pregame piece of it. So remember in the down market, right? The 3 things that investors, investment managers do, portfolio managers do. This is occurring in all your retail mutual funds as well. So it's not just a managed account, right? It's every actively managed fund. So one reason that we tell people this is we want them to understand the value of an active manager, because that then segues us over where we can, basically attack all the index funds that they hold, right? Because an index fund is only going to change their makeup on a quarterly basis. So all this activity that's occurring, that's like playing offense. That's a great thing. So when we talk to the clients, we're like, okay, you've got 2 years. So all of our clients have at least 2 years in cash, short-term bonds, maybe a little bit in a balance fund, right? So they have that cushion. We just remind them about the cushion. That's all we do for their income needs. And then we're like, look, this is the time when we play offense, when we're aggressive on this. And this is why you want to use us. So it helps us get a whole lot more money, whether it's retail or managed. The same thing's occurring. Okay. So I just wanted to reinforce that, Scott.
Awesome job, Kath. Hey, Kurt, the accolades are coming through the chat and the Q&A. So awesome job, but I'm assuming you're going to post some of those slides.
Yeah, yes, sir. Yes, sir.
Yeah. So everybody was asking that. Eldon, we got a lot of questions about people saying that they can't get on till 12:30, or you want to kind of address that?
I think that's a great thing to address. Yeah, you know what? We click it on about 15, 20 after the hour. We do open it up, but we are starting like as soon as it opens up within a couple of minutes, like it's like full on. And I realize maybe we got a technology issue where it's not letting you all in quick enough. So what we'll do next week is we'll give you guys a little bit more of an envelope. We'll open it up at a quarter after next week and kind of give a 4 or 5 minute window of time to allow all the entry, like everybody to get in to the room, and then we'll start. But yes, we will be kicking off the pregame stuff at 20 after. So we'll open it up a quarter after, 20 after. We're going to be full pregame show, and that way you guys know what the schedule is.
And we also can't be held responsible for what information you get between 12:15 and 12:20. It may set you back quite a ways, but we can't take responsibility for that. So Kurt, a couple things for you, buddy. You talked about the 50% retracement and how, and that was tremendous. Can you just say that again? Because I think a lot of people lost that.
Okay, sure, right. So the S&P 500 and went down 50% from its high. Okay. Now, or went down more than 50, excuse me. When it went, I'm said it backwards. The S&P 500 went down a lot from its high. It made up over 50% of that downturn. So it went down a bunch, made up just over half that. Since 1952, every time that's happened, the market has never went down and created a new low, lower than where it was prior to that.
Yeah, that's powerful. That's powerful for a lot of you to use. I mean, it's not to say it can't happen again, but that's a pretty good sampling of time, to be able to form your own opinions on. So that's awesome, buddy. Can you talk a little bit just about your thoughts on value versus growth and how you allocate it if you do?
Sure, right. Value traditionally is obviously a little bit more conservative than growth. Right now, I'm leaning clients more towards growth because growth has had more pain. And if you're an aggressive person trying to make money, I want to buy in the pain. Now, most people struggle with that emotionally, but logically, it makes perfect sense. But we do need to have some both. We can't be just in one area or the other. So obviously, I shouldn't say obviously. So certainly value has had a better year than growth, okay? But long-term growth normally has a little bit better total return. So I'm leaning more that way because it's in more pain right now for people that are trying to be aggressive and make money.
Okay, bud. Thank you. You talked a lot about the S&P. A couple questions came in about, is there ever a time where you would use the Dow in your comparison because a lot of people are very familiar with the name?
Good question. I typically don't because you really can't invest in a Dow. The S&P 500 is a much more common thing, quote unquote. You can invest in S&P 500 index funds. Okay. So I normally use that because it's a better representation of our actual economy, just as better than 30 mega giants. So I think the S&P 500 is a better representation of the US economy than 30 companies.
Cool. Excellent. Portfolio solutions, that was great. You used it in your example for funds. For people that are doing managed accounts, how would that have gone if your proposal had been on the managed account side?
Now, this is what's funny. Y'all are going to laugh at me and confirm I don't know anything. I have never, ever done a proposal for managed accounts, ever. Okay, I just sell on the concept of managed accounts. In addition to that, Portfolio Solutions doesn't give a true answer to a managed account. Number one, because of the fee structure, and number two, the Portfolio Solutions is going to look back at the funds that are currently that you keyed in, but the managed account could have sold and traded funds over the years, so it's not really giving you an accurate depiction. So you can't really use them for managed accounts.
Right, right. Agreed. Thank you. You want to open it up, maybe if anybody has any additional questions. Anybody wants to unmute?
Hey, could I make one more comment? Not about hunting?
Absolutely.
Oh,
Okay.
come on.
All right. So there was a question that came up, and I think this is a big thing, and maybe people have a comment on it, but it was Franklin Templeton just came out this morning, right? And they did the anatomy of the recession, which is that little chart with all the pluses and minuses. And there was a concern, it seemed like, with people on the, on the fact that it went more red, right? It's got more red X's in there. Go to the top, okay? Look at the jobless stuff. So see how that's all still green? So the point I wanted to bring up about this is it again goes back to client education simplified, which is, look, if people have jobs, if the job numbers are good, people have jobs, they're going to buy things. Okay, we can technically hit a recession at any point in time. We already did, actually, technically in the historical term, but the difference is the depth of that, right? How deep does that go and how long does it go? So your main driver is always on the top. It's always on the jobs, and then it's always also, which is the one you'd be concerned about here, which is on money supply. Right? Because that's telling you whether people are actually saving money or whether they're still spending. If they're still spending, you're still going to have inflation. So so I just went through all that, but all we really say is, look, guys, we're going to be watching jobs. We're going to see whether people have money, and that's going to be important. And we'll keep abreast of that as your managers are, so don't worry about it. We go back to what the plan is that we've set up for them, right? That we've got income for a period of time and we're taking advantage. We're being smart about what's happening now, so that we can take advantage and do better for them, in year 2, 3, 4 down the road. Okay. So don't freak out on the recession thing. Okay.
Hey, Kathy, excellent. I want to add to that. The recession in the stock market are two different things. They're not the same thing. Okay. So normally stocks slow down before we hit a recession, and normally stocks rebound before we're out of a recession. Okay. So about one of the articles, I don't think I use it today, but about 30, I think it actually was one of them today. About 33% of the people think we may hit a mild recession. But again, recession and stock market, two different things, folks.
Yeah, well said. And I'll just throw in on that, some of you may have heard the saying that the stock market looks 6 months ahead. So, where the market is today, it's not looking at where we are today. It's looking at the anticipation of 6 months ahead. So, the market will move before we ever get, real tangible numbers on that. That's great. I don't have any more questions. If anybody else wants to jump in, Kurt, awesome job again. That was really, really tremendous.
Awesome. All right, Brad, you want to close up?
Yeah, no, amazing show today. And I think I agree with Scott. I think the market's already priced in higher interest rates, and so the fear in the market, I hate to go back to what Warren Buffett always said, be afraid when everybody's greedy and be greedy when everyone's afraid. But for our clients, this is an opportunity for them. They just need you to go out and share that. And I love the example you gave, Kurt, that 7% is not the same in different funds. So in managed accounts, the idea is mitigate the loss so that our 7% actually turns out to be better for the client than the 7% in an unmanaged account. That justifies our fee the service we provide our clients. So anyway, thanks guys. Amazing show today. Kurt, unbelievable clinic. Talk to you all soon.
Do you want to mention about Tuesday?
Tuesday. What goes on?
Tuesday,
Tuesday?
jump
After
on
Monday, after Monday.
Tuesdays after Monday. Awesome.
jump on CRM, but then also tie into the LFIC training, just in case people aren't aware of that.
Absolutely. All right, guys, let's have an unbelievable September. Take care.
Take care.